All right, before we dive in, just a quick legal thing. This is purely for educational and entertainment purposes, okay? It's not financial advice. You've always got to do your own homework. Right. With that out of the way, let's get into it. You ever notice how some of the absolute best performing stocks are, well, kind of boring? I mean, while everyone is glued to the next big AI thing or the latest rocket launch, companies that might not even be profitable, the really smart money is often looking somewhere else entirely. They're quietly putting their cash into these giant, unassuming gray boxes like Cigna, a company in a sector most people actively try to ignore, healthcare. And this right here is where things get really interesting, because Cigna is not at all what you think it is. Today, we're going to pull back the curtain and see exactly why some of the biggest investment funds are snapping up this stock, while the average person, spooked by all the scary headlines, is running in the opposite direction. Okay, so to really get Cigna, you have to understand that it's not just one business. It's more like a high-performance machine running on two separate engines. You've got Cigna Healthcare, which is the part we all recognize, the traditional insurance plans for big companies. But the real beast, the engine that is an absolute money-printing machine, is a division called Evernorth. Now, the crown jewel inside of Evernorth is something called a PBM, or a pharmacy benefit manager. And you might be asking, what on earth is that? Well, think of a PBM as the ultimate middleman in the drug world. It's their job to manage prescription drug plans for literally millions of people by negotiating prices directly with the huge pharmaceutical giants. Probably the best way to think about a PBM is to picture the bouncer at the hottest nightclub in the world. All the big drug companies are lined up outside, just desperate to get their products in front of customers. The PBM is that bouncer. They stand at the door, they control the velvet rope, and they decide who gets on the approved list and exactly what it's going to cost them. By controlling access to millions and millions of patients, they have unbelievable negotiating power. They get massive discounts, and for playing this role of gatekeeper, they take a tiny slice of every single transaction. It is a business model built on pure, massive scale. Okay, so we've got this incredibly powerful business model. But what makes this story so compelling right now is the company's strategy. It's being led by their CEO, David Cordani. And frankly, he's made a series of moves that looked completely bizarre to Wall Street at first, but in hindsight, they were absolute strokes of genius. So just look at this timeline. First, in 2023, Cigna just walks away from a huge merger with Humana. Why? They refuse to water down the value for their existing shareholders. Then, they turn around and sell off their entire Medicare Advantage business for over $3 billion in cash. Now, you might think, why sell a profitable part of the business? Well, it's because they saw the writing on the wall. The government is starting to squeeze Medicare reimbursement rates, and that's absolutely crushing competitors like Humana and CVS. Cigna basically sidestepped a landmine and walked away with a huge pile of cash. So, what are they doing with all that money? Well, this brings us to what is, by far, the most powerful part of this entire story. Cigna is what sharp investors call a cannibal stock. And yeah, it's exactly what it sounds like. It's a company that is systematically devouring itself. And this number right here, this is the jaw-dropping result. In just the last 18 months, Cigna has bought back and basically erased a staggering 10% of its own shares from existence. 10%. That is one of the most shareholder-friendly things a company can possibly do. This slide explains it perfectly. Just think about a pizza. Imagine you own one slice of a pizza that has 8 slices. Now, what if the person who made the pizza buys back 4 of those slices and just throws them away? The pizza itself is still the exact same size, but suddenly there are only 4 slices left. Your one slice is now a much, much bigger piece of the entire pie. That is exactly what Cigna is doing for its owners. So let's recap. We have a fantastic business with a really brilliant shareholder-friendly strategy. But the story gets even better when we actually look at the numbers and see just how cheap the market is letting us buy this thing for. Let's talk about something called free cash flow yield. Forget the jargon for a second. All it means is how much actual cold hard cash does the business produce each year compared to its total price tag. For Cigna, that number is about 10%. So for every $100 you put in, the business churns out $10 of cash in a year. Now, compare that to the 4% you get from a risk-free U.S. government bond. The difference is just enormous. You're getting paid way, way more to own a piece of this incredible business. So that begs the question, if this is such an amazing deal, why is it so cheap? Well, the market is terrified. You see these scary headlines every single day about the government wanting to regulate PBMs out of existence. But here's the kicker. While the market is panic selling based on those headlines, Cigna's own executives, the people who know the business better than anyone, have been buying up stock with their own personal money. So you have to ask yourself, who are you going to believe? The panicked headlines or the insiders who are putting their own skin in the game?
Now look, that's not to say there aren't any risks. Of course there are, with any investment. But what's absolutely crucial here is to separate the real, tangible threats from all the over-the-top market noise and static.
So let's just break it down. The constant threat of FTC regulation against PBMs? Honestly, that's been a headline for over a decade. Real meaningful change on that front is incredibly slow and complicated. We'd call that mostly noise. What about losing a major client? Yeah, that's a real medium-level risk you have to keep an eye on. But the biggest one, the true black swan event that could change the game, is the explosion of these new weight loss drugs like Ozempic. These GLP-1 drugs are wildly expensive, and if demand goes through the roof, it could put a serious strain on Cigna's costs. That's the key risk to really watch. All right, so let's pull all of these different threads together and paint the final picture of what's really going on here with Cigna. So here's the thesis in a nutshell. What you've got is a company with two incredibly powerful engines, run by a brilliant CEO who is just laser-focused on creating value for shareholders. It's an aggressive cannibal, using its enormous cash flow to buy back its own stock, which makes every share left more and more valuable. And despite all of that, it is trading at a massive discount, all because the market is fixated on fears that, when you really look at them, seem pretty overblown. When you put it all together, the opportunity here is really simple. It's like finding a money printing machine for sale. You know it works perfectly, you know it's incredibly efficient, but the market has put a huge discount sticker on it just because the paint is a little scratched up from a few bad headlines. And that kind of leaves us with one final big picture question to think about. When it comes to building real long-term wealth, is it found by chasing trends and hoping to get lucky? Or is it found by patiently applying logic to find wonderful businesses that the market has, for a moment in time, completely misunderstood?